Today I am walking in the Richardson Bay Autobahn Sanctuary trying to escape the heat wave. I brought the heat from Miami to the Bay Area, but luckily it's only for a couple of days. It's like 90 degrees out here today, but no humidity, so it's still a lot hotter in Miami than here. But we're trying to keep cool. But we're going to talk about gas prices, inflation, as well as the end of millions of people receiving SNAP benefits, because all of this stuff is having a major impact on people's everyday living right now. Let's start off with gas prices, probably the most important thing and something that all of us can relate to unless you're an EV driver laughing all the way to the charger. Now, we got the latest inflation report that came in extremely hot at 4.2% year over year CPI reading, which is the highest reading that we have seen in years now. The problem with that is hourly earnings only increased 3.4% year over year, so almost a full percentage point less. And they say that the biggest issue with this CPI report is gas prices, and that's the reason why it came in so high. And if it wasn't for the high gas prices, it would be significantly lower. And then they say inflation adjusted earnings fell 0.7% compared with 1 year ago. That's not too good. Now, I've explained to people before on the channel how inflation is not caused by higher gas prices or companies increasing prices or anything like that. Inflation is simply a product of the Federal Reserve increasing the money supply. That's what it all boils down to, which is something that they have now been doing for a while after a brief pause back in 2022. And so it's not a surprise that we continue to see higher and higher inflation, especially since they've been relaxing interest rates now for close to 2 years. But with gas prices where they're at, this is having a major impact on people's everyday monthly expenses. You know, think about this. If you have somebody that drives 15,000 miles a year and you got to fill up multiple times per month in order to get to work and do all of your errands, pick up your kids from school, all of that stuff, you're literally spending hundreds of extra dollars right now from your annual budget that you weren't spending before. And that's just one extra expense. You know, it's not like gas is the only thing, but the gas prices have forced everything else up recently as well. These higher fuel prices are contributing to more expensive deliveries, higher shipping expenses, increased business operating costs, more expensive airline tickets, higher commuting costs, and rising prices at the grocery store, something that was already getting hit before the fuel shock. And according to economists, they're saying that consumers haven't dramatically shifted their spending just yet, but instead what they're doing is they are relying more heavily on debt. So it is a guarantee at this point that we are going to see the credit card debt numbers continue to skyrocket in the coming readings, because every quarter the Federal Reserve of New York releases the latest credit card debt figures, and it continues to go nowhere but up. They also talked to an economist over at America's First Credit Union, and he says that the credit union right now is seeing higher credit card delinquencies, more charge-offs, and slower demand for both new and used auto loans. Now, this is a credit union's bread and butter. Credit unions typically do lots of auto loans, especially since they give you a better deal than typical banks or the dealer financing for the most part. And the fact that they're saying less people are buying cars, more people have fallen behind on paying their bills, and others are just not paying altogether, that's what a charge-off is. What does that tell you? And so according to this, it says that Americans aren't necessarily cutting back enough to match their new reality. A lot of people are trying to maintain the same lifestyle even though their purchasing power is shrinking. That's very difficult, if not impossible to do, guys. Unless your income is going up, you are not going to be able to do this for very long. You know, people are going to continue taking on more and more debt, and those delinquencies will build in the background, and will come a point where you can't take more debt because you won't be offered it. And one thing I've been telling people forever on this channel is the answer isn't to try to keep up with the Joneses and keep up with your old lifestyle, guys. It is budgeting harder. It is increasing your income. It is building up that emergency fund and cutting back on unnecessary expenses. But so many people are unwilling to do that because that's not sexy. It's not fun. It sucks to trade down your lifestyle for any reason. And with this latest inflation reading at 4.2%, this is the highest reading that we have had going back to April of 2023. So that is significant. Basically 3 years since we've seen a CPI report this high. So that's a big deal. Now, according to the Labor Department, the energy category accounted for 60% of the monthly increase in the consumer price index. So 60% is significant, okay? But once again, that's not reality, because higher fuel prices do not equally translate over to higher inflation. The way that the government measures it, sure, but it's not how things actually work in the real world. They want you to believe that the higher gas prices are the magic reason why inflation is higher, but that's just an easy thing to hide behind. Every time I see this old house over here, it kind of reminds me of that Addams Family house, a similar old architecture. But they're saying, look, if the energy prices hadn't surged, core inflation, which strips out food and energy, is coming in at 2.9% year over year, which is only slightly above April's 2.8%. So even the good news that they try to spin this story into is still actually pretty bad, because 2.9% is still a healthy clip higher than the 2% that the Fed has been supposedly aiming for years now. And this just goes to show you guys that the fuel prices are not why inflation continues to go up. We would still have a very strong inflation reading even without this energy shock. That's only adding to the problem. It's just amplifying the problems we already had. And the other problem is people don't live their lives based on all of these bogus inflation numbers. People live their lives based on what they really have to spend at the grocery store, at the gas pump, on insurance, on healthcare. And we've all seen those things explode far beyond whatever these numbers are telling us. And I kind of have said before that I wanted to kind of get away from talking about these inflation numbers because of how phony they are. But sometimes I just can't help myself, guys, because this is something that I kind of saw coming for a while now. And I wanted to report on this because it was only a matter of time before inflation started going back up again, because we've seen this happen throughout history. Even though we kept getting promised that it wasn't going to happen and it was all going to go away and everything was going to go back to normal, it's been nothing but the opposite. And I just wanted to point that out for anybody who thought differently. But some of the big outliers in this report were gas prices were up 40% from a year ago. Airline fares are up 2.7% from April. And energy prices increased 3.9% in May alone. But there were a couple of areas where prices came down only slightly. Car insurance actually came down 1.7% in May, down from April. And I can actually back that up because I am somebody who recently got a small rate reduction on my car insurance renewal. It wasn't a lot. I think they lowered it by, $18 or $20, nothing substantial. But hey, in this economy, I'm happy to see any sort of bill that I'm getting right now get reduced. And I'm sure a lot of other people would agree with that. They say prescription drug prices went down 0.9%. New vehicle prices went down 0.3%. So is that stuff really helpful? No, not really. Probably just the car insurance one makes the biggest difference. But according to this story, we are getting hit from all different angles in this economy right now. We have so many things that have kind of recently been introduced that are making things a lot worse for everybody. First is the tariffs. A lot of the tariffs are still in place, making all of the imports that we buy more expensive. Secondly, you have this recent energy shock that we've all been going through for the past couple of months, which has probably been worse than the tariffs. I think everybody would agree. And then the last thing is this massive boom with AI has been driving up the demand for electricity with all the data centers. And some people have seen their electric bills absolutely skyrocket from this, and their quality of life degrade substantially if you live near one of these things. And finally, the stock market has been reacting negatively to this bad news, because for the longest time, bad news was good news when it came to the stock market. But the Dow plunged 953 points, while the S&P 500 fell 1.6% and the NASDAQ fell 2%, all on this most recent inflation data. And in the past, it seemed like none of that was enough to really move the needle. But I think people are finally starting to wake up that, hey, maybe these problems are permanent and things are actually a lot worse than what we thought. And once I read all this stuff, it kind of led me to a big question that I'm sure a lot of you guys have as well, which is that where should I put my cash with all of this inflation? Because cash is never a great thing to hold on to, even in normal times with inflation. And for a while there, during high periods of inflation, we saw the high yield savings accounts offering north of 5.5% on a lot of the savings account yields, but now many of them have fallen below 4%, guys. I think the best one that I have right now is just dropped under 4%. It was like 4.02%, and now it dropped to like 3.89 or something like that. It might even be 3.75. The thing that's so frustrating about this is we continue to see the inflation numbers get worse and worse, but we continue to see our high yield savings accounts rates go further and further down. And why is that happening? It's because the Federal Reserve is not reacting to this news. They should be hiking rates substantially right now. But because they haven't done that, at least not yet, maybe they will, maybe they won't, we're stuck with these artificially low interest rates from the bank paying negative on our money when accounting for inflation, which is no good. So what are you supposed to do about it? That's something I've been wondering. Well, the truth is there's no real good answer, because everybody needs to have some cash on hand for an emergency fund or a rainy day fund, whatever might come up, or just if you have some liquidity to make a future investment. But my number one suggestion, and this is just a suggestion, guys, I am not a financial advisor. It's just what I choose to do when I have excess cash: gold and silver. The prices have actually been coming down recently on all this high inflation data, which sounds counterintuitive, but it's only going to be a matter of time before the gold and silver values continue to skyrocket once again, once reality catches up, just like we saw happen over this past year. So I think if you're somebody who doesn't need the money right away and you're looking at preserving the value of that cash, gold and silver is great. You're always going to need to have some actual cash on hand for your emergency fund. I'm not saying to stick your emergency fund into gold and silver. You're still going to need to have it in a high yield savings account or a brokerage account or a money market fund, somewhere where it can be withdrawn very quickly and without any penalties. And now that the prices of these metals are down recently, it could be a good time to buy some more. But if you're not a fan of gold and silver and you do need the money to be more liquid, and you don't want to have to take a loss on your gold and silver, maybe going for some of the traditional stock market options, whether that's ETFs or an S&P 500 index fund, whatever you feel comfortable with and you trust, you could go that route, which is probably going to yield more than a high yield savings account that's paying 3 to 3.5% right now. CDs are not really a great option either. They're barely paying more than most high yield savings accounts, and you have the downside of keeping your money trapped in there for a certain amount of time without paying a penalty. The only other thing I would suggest is if you're younger, this isn't going to be for somebody retired looking to preserve their wealth, but if you're somebody younger and you want to take a little bit more of a risk, start a business, guys. Take that money and invest it into yourself. Invest it into starting a business that's going to be able to pay you more than how much these inflation numbers are going up, because that is the main way that most Americans end up getting wealthy, first of all, and you're going to have far more control over your life and your income and your schedule than most people. And if you're willing to work hard, it's really going to pay off. But it's definitely not for everyone, especially if your only goal is just to preserve the value of your cash. But I'm sorry to report to you that there is no good option left for doing that other than gold and silver, which is more of a long-term play. You have to keep your gold and silver for a good amount of time in order for it to pay off. Some people got lucky who bought it maybe 2 or 3 years ago and have seen the prices climb substantially. And I haven't heard any complaints from anybody who's bought it because of that. But this isn't something that you're going to buy and then sell tomorrow for a profit like trading stocks. Sure, I guess you could do that if you buy paper gold and silver in the exchanges, but that's not what I'm talking about. I'm talking about buying real physical metals.